At this point, we've covered some very critical areas in terms of overarching themes and concepts that you always need to be considering when, putting together your plans in terms of, what strategy should I select. In this, we're going to take it a little bit further, and we're going to talk about that key step in controlling risk. So we're going to quickly go over that. And yes, I said quickly because this is a concept that I'm assuming is going to be reviewed for the majority of you, given this is an advanced options course. But if it's not, I still want to just reiterate, even if you understand these principles, why it really is so important when it comes to controlling risk. Now, before we get to this slide, I want to just, I've used this before, but as a real estate investor myself, one of the key things that I learned when I was investing into my education in the real estate realm was the slogan, when you're on real estate deals, you make money when you buy, not when you sell. In other words, if you're not buying it right, if you're not entering in at a good value, then because you got to rehab the house, you got to fix it up, you got to get it sold or rent it out or whatever, lots of things can go wrong. So the money in real estate is made at the purchase, not at the sale. And the same principle here within options. In other words, we got to make sure that we're approaching and getting into the trade in the right type of way. Now, I did lie somewhat, but in a good kind of way. The key step we've actually already talked about in terms of risk control, and that's the quality control pyramid. And I try to get a little cute here with the words. I do know how to spell quality, but because the K is down there at the bottom of this image, and if this doesn't summarize a trader's job, then I don't know what is. That's pretty much what trading is, whether it's options, stocks, forex, futures, bonds, commodities. We are just trying to balance on top of risk and making sure that things don't spin out of control or things don't get out of control. So that's I love the image. When I saw it, I just couldn't help myself, and it works out pretty perfect because without the quality control pyramid, which you now hopefully understand the vast importance of, this whole thing, we're going to come tumbling down as traders. So technically, this is the key. So that's at the bottom, but following very, very closely behind is entering into the trade. Now, this has nothing to do with the price. Usually when you, especially if you're thinking, let's just say stocks, for example, or even real estate, you're thinking, I need to get in at a good purchase price. Very, very true. That is an important part for stocks or for real estate or for many things. But with options, it's a little bit different. We don't really care about the entry price. I mean, we do, but more important is actually the entry strategy. And strategy, you can see the S is right there, the second part of our little, stack of risk there. And that's very, very important too, because if we don't get the right entry strategy, then we're really going to be behind the 8 ball, and it's not going to be pretty for us in terms of an overall risk perspective. Now, I already kind of hinted at this, but it's not very complicated in terms of what these strategies are, and there are only 2 of them. And like I said, for many of you, I'm assuming this will be a review. When it comes to the entry strategy, there's 2 choices. And at the core, it really boils down to you got 2 questions you need to ask yourself. Do you want to put money into your pocket at the start of the trade or later on in the trade? So just to review, but what's going on? What are our 2 entry strategies? Well, the first is buying premium. Now, you could also hear it as going long, and you would be technically called an option holder. Again, that's buying premium. So what does buying premium mean? Well, it's essentially the same as buying a stock. Whenever you buy a stock, what immediately happens? Well, you go into the hole, meaning you are paying somebody, so money is coming out of your account. Now, I'm not saying that the money you can't come out of the hole, but I like to picture it as, putting yourself in the hole, and there is a ladder there. So, I mean, like I said, I'm not saying you can't climb out of the hole and get yourself out of the hole, but you do start behind because you are paying, right? It's a debit transaction. Money is leaving your account. Hopefully that's a very straightforward concept. The same thing happens when you go to buy a gallon of milk at the store. That is a debit transaction. Money is going out of your pocket. But at least with stocks and options, if you go into the hole, you do have a chance to not only get that money back, but then make some money. But that is buying premium. Now, on the other side of things, you can sell premium. So selling premium, you can hear it as shorting premium, going short premium, but you are known as an option writer. Now, the difference here is that I like to call this a piggy bank transaction because you are getting paid. You are literally profitable from the first second of the trade. And that's, like I said, not an exaggeration. As soon as you sell, you're getting money paid to you. Where's this money coming from? Well, it's coming from the person over here that's going into the hole. They are paying you to go into the hole. So they are putting money into your piggy bank, and they're going to go in the hole with hopes of being able to climb out of the hole and then make money on it. So yes, when you're selling premium, shorting premium, you are literally profitable from the first second of the trade. There is a catch, and of course, that can always change. I mean, if you're not managing the trade, then yeah, you can. That profit can quickly disappear, just like the debt in this situation can quickly disappear as you get out of the hole. With this, somebody can come and break your piggy bank. Hit it with a hammer. Wow, that's a terrible hammer. I don't know. I guess that's the handle down. Okay, let's just pretend like I didn't try to draw a hammer. But somebody can come smash your piggy bank and then take your gains too. So yes, it sounds very alluring, and it is, because you are just getting money right from the get-go. But of course, there's a catch. And the catch is this. The market is very efficient. Not just the options market, but all markets. You've heard me say that before. Basic principle in economics states there are always trade-offs. And that's, the trade-off, I guess I'm maybe a little hungry right now, but the trade-off, I can go eat ice cream. And ice cream is very, very good. But the trade-off is it's not very healthy for you. So there's a little trade-off there in the world of nutrition. In options, and with our two entry strategies, our two trade-offs come down to freedom versus obligation. So buying premium, the pro of this is it gives you total freedom. You are not obligated to do anything. Even if your option finishes in the money, you don't have to exercise it. So you have total freedom. You can do whatever you want. Like I said, the extent and why I put that second part in there is just to show the ultimate freedom. Because even if that option, and you're right, and it finishes in the money, you don't have to exercise it if you don't want to. So pure freedom. Now the con of this is that you start off in the hole, which we've already addressed, and then think back to a couple videos ago when we talked about time risk, and we're going to learn more about how that works in the next video when we talk about the Greeks. But time risk is working against you when you are buying premium. So those are the cons. Now let's flip over the other side. When you're selling premium, the con here is that you are obligated to honor the agreement you made with the buyer. Remember, a buyer has purchased an option from you, and basics, the option is a contract, and as the seller of the contract, you must honor it. But again, going back to the ultimate freedom, the buyer participating in the contract, they don't have to honor it. If it finishes in the money, I don't want the shares. But you as a seller, if that buyer wants the shares, and vast majority of the time, they're going to exercise it. Then you have to do it. So you are obligated. So that is, a big flip side to things is that whole thing of obligation. You certainly do not have pure freedom. The pro for selling premium is, again, it's a piggy bank transaction. So you are getting money immediately into your piggy bank. The other pro is that time risk works for you. So buying premium, time risk is working against you. Selling premium, time risk is working for you. And we'll be getting more into that as we go, but just, the overall arching principles right now. And for the final slide, I have yet another confession. I lied to you again, but it's just a little teeny white lie. I said there are two entry strategies, but it's actually unlimited. So what do I mean by this? Well, we've already covered the two, right? You can buy, put yourself in the hole, or you can sell, put some money in your piggy bank. But then, and this is what we're going to look into, you have strategies where you can do both. Little combo things. You can be buying premium and selling premium at the same time. And then up here, we have our scale. And this just represents, how much you weigh different things. So sometimes you're going to be selling more premium than you're buying. Maybe other times you're buying more premium than you're selling. So it's not an even distribution at times. Sometimes you have more weight into buying premium versus weight into selling, or vice versa. Sometimes you're very heavy into selling premium and you just have a little bit of buying premium. So combinations, there's those are the three core. You can either be buying, selling, or buying and selling. But then within that, it's just a big, the further and further you go, you can get very creative with it. Which brings me over to the other diagram here. And the beautiful thing, and as I've already touched on, in the introduction video, is that creativity. Get creative. There's lots of things you can do. But I do have this zone Because while creativity is great, and while I'm a huge fan of the very cliche saying think outside the box, with options trading, we need to stay inside the box. Now, why am I encouraging people to stay inside the box? Well, think about the magnet. Hopefully you understand how the magnet works, and don't try to get creative to the point and think outside of the box where all of a sudden the magnet is working against you. Because as you've seen with the blowfish effect, that's not a good situation to be in. So there is a box, and the magnet, for example, is one of those components that is the box. If you're trying to get fancy with the magnet and trying to get get all fancy, I guess. If you're trying to just out fancy, I'll create a word. If you're trying to out fancy the magnet, as an example, and being outside the box, that's not where you want to be. You can get creative. You can, do combinations, do things at different weight levels. That's fine. But there are core principles, that you really shouldn't be venturing outside of. So we need to stay here into the creativity zone. We'll be going over some strategies, but the strategies are just people that have gotten creative in the past, and they've come up with weird names for them. And who knows, maybe you can come up with a weird name for a strategy that you've come up with. But again, I'm all for people, experimenting and getting a little creative. But with this, we need to stay inside the box. So don't out fancy yourself. That's probably the best way to put it. So that wraps up this video. You now know that the key kind of step here in managing risk. And I say it's key, and it may seem, wow, that was very straightforward. Yeah, it is very straightforward, but let's reference that blowfish effect again. What made that so bad? Now that you understand the two methods, the people that bought premium in that situation chose the wrong entry strategy. They should have been selling premium. Again, blowfish effect. If you were selling premium, then the blowfish effect, you love it, right? Because those prices, you were shorting, it was a thing of beauty. But going back, I started with the real estate, and I want to end with that real estate example. The money in regards to that blowfish example was made right at the get-go in terms of, well, what strategy should I use to enter? If you chose to enter by buying premium, wrong strategy, you were screwed over before really the trade even got started. If you're selling, that's a whole different ballgame. Same as real estate. You make money up front. Not on the sell, you make money on the entry point. And that's that's why I love the correlation here between trading and then real estate investing. So let's keep on progressing through the course. Next up is the Greeks.